Alrighty guys, what is going up? Welcome back to the best investing money management channel on YouTube. In today's video, we are going to be talking about SoFi Technologies. What in the world is going on with this company? Now, you guys know I am a huge bull on SoFi's. I've been buying this stock for a minute now. One of the main reasons was clear support at $14 and a huge upward potential. Honestly, those were the things that I really loved about it, all broken down. Okay, support here, you guys can see it gets bought up every single time. Boom, 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 boom. So it's just been consolidating, not falling below, but pretty much just not doing much, right around this, 1450 mark. Now, today we had this huge amount of buying pressure. Okay, you guys can see the stock is up 11%, which that's absolutely crazy, right? If you compare it to the S&P 500, the S&P 500 isn't even up 1%. Large company like Apple isn't up as much, 1.6%. So a company like SoFi, when it gets 11%, that high, and it was up about 4 or 5% pre-market, there's something going on. And so before we jump into kind of what's going on, for those of you that don't know what SoFi Technologies is, SoFi Technologies is pretty much a fintech stock, right? They have a mobile app that allows you to buy and sell anything from stocks, crypto. They have a savings account, credit card. They have a debit card. You can take out loans. They make a ton of money, and they've been growing at around, anywhere from 50 to 60%. Huge upside. The only downside is there's a little bit of, competition in that sector right now if you compare it to like M1 Finance or like a Robinhood. Those are really the main two. So what's going on with SoFi? Okay, so I'll show you the article here so you guys can see. So this is on the Motley Fool. So, I don't know if it's 100% right, but it most likely is. Okay, so it says, the stock's up 10% as of 11 a.m. So the main reason why it's up that much is because it's being fueled by an analyst rating. Okay, especially Jefferies, and they said it can hit a target price of $25 per share, and that implies a 50% upside. So now when we go back and look at a stock that's, $15 or $14, the upside to 25 here is 70%. Even right now, if we hit this mark at 25, that's still a 31% change. So in some aspect, this stock could be still tremendously undervalued. And now, would I recommend going crazy buying shares of this stock? No. What I would recommend doing is honestly using a very simple strategy called dollar cost averaging. So what you do for a stock that's a little more of a higher volatility, if you compare it to just the general market, one that goes up and down at rapid rates, the dollar cost averaging, what you do is you figure out however much you want to invest, your principal amount. So I always recommend, anywhere from 1,000 to about 2,000. Okay, that's just me. Everybody has obviously their own investment. So what you do is you take that 1,000, but you don't have to put that 1,000 all up front. What you'll do is you'll invest $100 a week over the next 10 weeks. So you still invest that $1,000, but what you do is you spread it out into weekly increments. So the beauty of it is if that just say SoFi starts going up, you still make money on it because you have shares and the share value is going up. Now, the beauty of it is when it starts falling down like it's done in the past, what you do is you average down your shares. So when the stock recovers, just like it's done, you make a lot more money. It's a fantastic and very simple strategy to use, especially for these high growth stocks because of the overall volatility. You never want to buy when it's up here, even though it's extremely attractive because we have this huge buying pressure and you think that it's never going to stop, right? So I'll give you an example. So something like this, or even like this, would be a little better. So you guys can kind of see what I mean. So if you saw this as your chart, you'd want to buy into this because you think the overall trend could continue. And realistically, It could, but anytime something's a little bit overvalued and has gone up that fast, it's due for a sell-off. And it sells off, you average down your shares, and you continue to buy it, right? So when it sells off, you're just buying pretty much a lot of these dips. So now, when it goes back up, you're making a lot more money because your average shares are extremely low. And then it falls down, you average more, and it goes up and you make a lot of money. So with the upside being 30%, I always recommend buying a little bit. Anything, I want to go crazy, like I said, anything from 1 to 5% of your portfolio. So if you have $100, put, $1 or, $5 into this because you're a beginner. Dollar cost average it so you can get those shares and grow your account. So guys, that is it. I hope you guys enjoyed it. And if you did, hit that like button and subscribe, and we'll see you guys later. Take care.